Today's odds, 21%. That's the probability the market assigns to the AI bubble bursting by December 31st, 2026, as companies making eye-watering losses look set to IPO at near trillion-dollar valuations. That's roughly the same probability assigned to Trump staying Epstein or 6-7 by the end of the week, which is to say, not likely, but not something I'd want to be shorting with my children's inheritance. Welcome to Prediction Market Prof, where we analyse global affairs through the lens of prediction markets and try to profit from the wisdom of the crowds. This week's market movers. Yes shares in Musk winning his case against Sam Altman dive to 1% as the jury finds the statute of limitations has expired. Yes, Elon, if you had a problem with OpenAI becoming a for-profit empire, you might have considered mentioning it before it became a for-profit empire. Odds of Trump posting over 200 Truth Social posts this week surged to 95%. Honestly, if my granddad was up till 3 a.m. rage posting about the Democrats, I'd take away the phone and check whether he'd been licking the lead paint. And yes shares in oil dipping below $80 by the end of June briefly spiked from 33% to 45% as Trump predictably tacos again on escalating military action in Iran. But they quickly reverse as the market regains its sanity, or at least remembers that one social media post is not foreign policy. Today, we're talking about AI. Love it or hate it, AI has become increasingly central to the global economy. Big tech now makes up an absurd proportion of the largest stock market in the world. The 10 largest companies are roughly 70% of the Nasdaq 100 and around 41% of the S&P 500. So at this point, the US stock market is not really a diversified basket of 500 companies, it's a giant AI-themed Jenga tower with Nvidia standing at the bottom holding a very expensive GPU. And yes, the technology is impressive. I use it all the time. I use it to find academic research, generate YouTube thumbnails, plan travel, write minutes, and occasionally ask whether the strange noise in my car is expensive. Spoiler, it always is. But the investment case is not the same as the technology case. OpenAI and Anthropic are still private companies, so we don't have the kind of public balance sheet detail we would get from listed companies. But what we do know is enough to make your left eye twitch a little bit. OpenAI's latest funding round valued it at around 852 billion US dollars. Anthropic is reportedly being valued at around 900 billion. These are near trillion-dollar valuations for companies where the public still has limited visibility into the actual economics. And then there's SpaceX, which is reportedly heading towards an IPO valuation somewhere between 1.5 and 1.75 trillion dollars. That is not 100 times earnings, it's worse than that. It's potentially more than 100 times revenue. When there are no earnings, the earnings multiple becomes less valuation metric and more religious experience. Now, I'm not saying AI is going away. I'm not even saying the valuations are definitely wrong in the long run. Maybe this really is the next industrial revolution. Maybe half the economy will soon be replaced by agents, robots, and a chatbot named Nigel who does your taxes whilst judging your life choices. But even if AI is world-changing, that doesn't mean current prices make any sense. The internet changed the world. It revolutionized business. And yet, the dot-com bubble still burst. Amazon lost about 97% of its value from peak to trough. Now, if you held through that crash, or better yet, bought the bottom, congratulations, you're now rich enough to fund a small navy. But a 97% drawdown is not a dip. That's financial burial followed by resurrection. And that's the point. A technology can be real, a company can be real, the future can be real, and the stock can still be insanely overpriced. The semiconductor sector is where this gets especially interesting. SOXX, the semiconductor ETF, has had a massive rally. Not one meme stock, not one overexcited AI name, an entire sector. These are the picks and shovels of the AI gold rush. Nvidia, Broadcom, AMD, ASML, and the rest of the machinery behind the miracle. But from a technical perspective, the move looks very stretched. Momentum's been weakening, the trend has started to crack, and with Nvidia earnings coming up, we may be approaching the point where the market asks a very awkward question. Hang on, how much of this growth is already priced in? When Nvidia rolls over, when earnings top out, that may be the signal. But are we there yet? I don't think so. My guess is that the real pop comes after the IPOs. The hype probably has enough fuel to keep going until retail investors can buy OpenAI, Anthropic, and SpaceX directly. That's usually how these things work. Private investors get the early rounds, institutions get the roadshow, retail gets the inspirational CNBC segment, and ends up holding the bag. When reality hits home, I think there's a very high chance some of these stocks absolutely tank. Now, in ordinary markets, you could short them after IPO, but shorting hyped meme stocks like megacap AI stocks is a good way to discover that unlimited losses is not just a phrase in a textbook. Options are cleaner, buy puts, and the maximum you can lose is the premium. But this is a prediction market show, so what is Polymarket offering? Polymarket has yes shares on the AI bubble bursting by year end, trading at around 21 cents. And as always, the first rule of prediction markets is read the bloody rules. This market does not resolve yes because someone on Bloomberg said bubble burst. It doesn't resolve yes because a Goldman analyst writes a note called Are We Cooked? It doesn't resolve yes because Nvidia drops 20% and everyone X starts posting the dog in the burning room saying this is fine. For this market to resolve yes, at least 3 listed conditions have to occur within a 90-day window before the deadline. Those include Nvidia down 50% from its all-time high, stocks down 40%, OpenAI or Anthropic declaring bankruptcy, OpenAI being acquired, H100 rental prices falling to $1 or lower for 5 consecutive days, or a major hardware supplier like TSM, ASML, Broadcom, Arista or Supermicro dropping 50% from their all-time highs. That is a much harder market than the title suggests. I can absolutely imagine SOXX, SOX, falling 40% when the AI trade rolls over. I can imagine Nvidia taking a proper beating. I can imagine some hardware suppliers getting absolutely mauled. But OpenAI and Anthropic are not likely to declare bankruptcy this year. OpenAI being acquired by Microsoft is possible in the long run, but within this market window, much harder. H100 rental prices falling to $1 for 5 consecutive days is also a very demanding condition. They currently trade well over $2, and some hardware names may have already had large drawdowns, but outside the 90-day window that matters. So this isn't really one bet, it's an accumulator. You need 3 things to happen close together before year end. Possible? Yes. Mispriced at 21 cents? Maybe, but the maths is freaking impossible. Easy money? Absolutely not. So I'm not going to trade that. How am I going to do it? I'm going to look at the market for the world's largest company. And this is actually something some of the Polymarket whales tend to do. If the AI bubble bursts, I think Nvidia is more vulnerable than Alphabet. Alphabet is not immune. It has Gemini. It is spending heavily on AI. It depends on advertising, so inflation and recession risks matter. But it's not as pure an AI infrastructure trade as Nvidia. And despite the market treating Nvidia like the final boss of capitalism, Alphabet is not that far behind. Nvidia is only about 15–16% larger by market cap. Alphabet shares in the largest company market are trading at around 25 cents. That looks much more attractive to me than the AI bubble market. So this is how I'm structuring the trade. Not the AI bubble definitely burst by December, but if the AI trade starts to deflate, Alphabet has a decent shot of overtaking Nvidia. I can win without the bubble fully bursting. Of course, I can lose even if it does, but compared with the Polymarket AI bubble contract, I think it's cleaner, less overspecified, and less dependent on 3 separate disasters lining up neatly within 90 days before the end of the year. So yeah, let's try and avoid the world's nerdiest apocalypse bingo card and go for something much simpler. Quick update on our other trades. Starmer out by June 30th rallied hard on news that the Health Secretary might run against Andy Burnham for Labour leadership, and we sold half our shares for about a 60% profit. They then sold off when the market remembered that Starmer had not, in fact, resigned and showed no obvious intention of doing so merely for our convenience. So we're now out of that position. We took a little bit of a loss on the rest of our shares. There's little to report in the Middle East. Trump's visit to China achieved nothing of note. Inflation still looks sticky. There are promises of deals, but of course, no deals. and the massive volatility under Trump's posts is noticeably reducing. People seem just not to take him that seriously anymore. At this point, one tweet from the Iranian regime, oppressive and murderous as they are, is probably more reliable than 1,000 Trump posts if you're trying to work out what's happening in the Strait of Hormuz and where gas prices are going to next. Okay, that's all for today. Thanks for listening to Prediction Market Prof. I'm Professor Benjamin Smart. If you enjoyed this content, please like and subscribe, and I'll see you on the next one.